Imagine this scene for a moment. You wake up on a Tuesday morning, not to the jarring sound of an alarm clock, but to the gentle morning light filtering through your window. You stretch and reach for your phone on the nightstand. You scroll past the usual notifications. One notification stops you cold. $42.50, dividend received. Close to your coffee on a sunlit table. Before your first sip, before brushing your teeth, your money has been hard at work. This isn't a lottery win or a fantasy. It's the result of a smart financial strategy. This is passive income. Many think passive income is a myth reserved for the ultra-wealthy. It feels like a secret club with a high barrier to entry. Most people believe you must trade time for money in a 9-to-5. You work hours, you get a paycheck. But what if there was another way? What if income flowed into your account while you slept or spent time with family? This isn't get rich quick. It's building financial resilience. The core idea is simple. Make your money earn more money for you. You deploy savings into assets that produce cash flow. Think of it as hiring tiny, tireless employees working 24/7. Each dollar becomes a worker building your wealth. This piece will break down the walls and demystify the process. We'll show that with knowledge and a plan, anyone can start passive income streams. Today, we'll dive into 3 foundational pillars of reliable investment income. These are not speculative bets. They are time-tested strategies used by millions. Dividend stocks, real estate investment trusts, REITs, fixed income strategies like bonds. By the end, these terms will be tools in your financial toolkit. This essay is not just about defining financial terms. It is about providing you with a clear and actionable roadmap. My goal is to guide you step by step through the process of transforming your savings from idle cash into a dynamic, income-generating machine. We will move beyond the theoretical and focus on practical application. You will learn not just what these investments are, how to find them, how to evaluate them, and how to combine them into a cohesive strategy that aligns with your personal financial goals. Forget the confusing charts and the overwhelming amount of information you might find elsewhere. We are going to simplify everything, focusing on what truly matters for a beginner investor looking to create a reliable income stream. We will begin our journey with the most classic form of passive income, dividend stocks. When you own a share of a dividend-paying company, you are entitled to a piece of its profits. It's like the company is sending you a thank you check just for being an owner. We will discuss how to identify strong, stable companies, Coca-Cola, Microsoft. More importantly, we will dissect the difference between chasing a deceptively high yield and focusing on sustainable dividend growth, a crucial distinction that can protect your portfolio from risk and set you up for long-term success. This first pillar is all about becoming a business owner without the headaches of running the business yourself. Next, we will venture into the world of real estate, but not in the way you might think. We will explore real estate investment trusts, REITs, massive shopping malls, apartment buildings, data centers, industrial warehouses, with just a few clicks. REITs are legally required to pay out most of their income to shareholders, which often results in very attractive and consistent payouts. This second pillar is your key to becoming a real estate mogul without ever having to deal with a leaky faucet or a late rent payment. It is property investing made simple, accessible, and liquid for the everyday person. Finally, we will cover the pillar that provides stability and peace of mind. Fixed income investments, such as bonds, T-bills. In an uncertain economic world, having a safety net is not just a luxury, it is a necessity. Bonds represent a loan you make to a government or a corporation, for which they promise to pay you regular interest payments. With interest rates at their most attractive levels in years, this pillar has become an incredibly powerful tool for generating safe, predictable cash flow. We will break down simple yet effective strategies, like the bond ladder, that can help you secure a steady income stream while protecting your principal investment. This section will ensure your financial house is built on a solid foundation, allowing you to sleep well at night. Let's begin with the cornerstone of income investing, dividend stocks. At its core, the concept is beautifully simple. When you purchase a share of a public company, you are not just buying a digital ticker symbol that you hope will increase in value. You are acquiring a tiny piece of ownership in a real operating business. Whether it's a technology giant like Microsoft developing the next generation of software, or a consumer staple powerhouse like Coca-Cola selling beverages around the globe, you become a part owner. As an owner, you're entitled to a share of the company's success. When that company generates profits, its board of directors can choose to reward its shareholders by distributing a portion of those earnings. This distribution is called a dividend. Think of it this way. Imagine you own a small percentage of a local rental property. Every month, after all the expenses like mortgage, taxes, maintenance are paid, there is profit left over. As a part owner, you would rightly expect to receive your portion of that profit. A dividend works in precisely the same way. It is the company's way of sharing its financial success directly with you, its loyal owners. This payment is a tangible return on your investment, a cash reward that arrives in your brokerage account without you having to sell your shares. This creates two ways for you to make money, through the potential increase in the stock's price and through the regular income the dividend provides. This dual return potential is what makes dividend investing so powerful. Historically, dividends have played a monumental role in the stock market's total return. Over the long term, a significant portion, often cited as over 1/3 of the S&P 500's total gains, have come not just from stock prices going up, but from the steady, consistent reinvestment of these dividend payments. This fact is often overlooked by those chasing quick profits, but it is the secret weapon of patient, long-term investors who understand that wealth is built through both growth and income. This income stream provides a crucial psychological and financial cushion, especially during volatile market periods. When stock prices are falling, the sight of a dividend payment hitting your account is a reassuring reminder that the underlying business you own is still operating and generating cash. While other investors are panicking over short-term price movements, you are still getting paid. The dividend acts as an anchor, grounding your portfolio in the real-world performance of the businesses you own, rather than the unpredictable whims of market sentiment. It transforms investing from a speculative gamble into a long-term partnership with successful enterprises. Not all dividend-paying companies are created equal. For investors seeking reliability and long-term growth, the true gems are found within an elite group of companies. Dividend aristocrats and dividend kings. A dividend aristocrat is a company that is part of the S&P 500. It has paid and increased its dividend every year for at least 25 consecutive years. That track record signals exceptional financial strength. It also signals a durable competitive advantage and a management team dedicated to rewarding shareholders through thick and thin. Even more exclusive is the esteemed club of dividend kings. To earn that royal title, a company must increase its dividend for 50 or more consecutive years. Think about what that means. These companies have navigated multiple recessions, market crashes, geopolitical conflicts, technological shifts, and still they consistently give owners a raise year after year. Companies like Johnson & Johnson, Procter & Gamble. Their streaks demonstrate an almost unbreakable business model. Investing in these companies isn't just a bet on a single product or quarter. It's an investment in decades of proven resilience and a culture of returning capital to shareholders. When first venturing into dividend investing, it is natural to be drawn to the stocks with the highest yields. An 8% yield, a 10% yield, a 12% yield. Those high yields feel tempting, promising rapid passive income. However, this is often a classic beginner's mistake called the yield trap. An unusually high dividend yield is frequently a red flag, not a green light. Yield, annual dividend per share, stock price. A very high yield can result from a rapidly falling stock price. A falling price often signals deep problems in the business. Investors are selling for a reason. That reason can jeopardize the dividend. A more sustainable strategy is focusing on dividend growth over a high starting yield. Consider two hypothetical companies. Company A, an 8% yield. Company A, no dividend increases in years, shaky balance sheet. Company B, a modest 3% yield. Company B, long history of raising dividends, from 10% annually. Short-term, Company A gives more income. But after a few years, Company B's growing dividend overtakes A. A decade later, Company B's income stream and stock likely perform better. Protect yourself. Do a few practical checks. Check 1. Payout ratio. Consistently above 80% is a warning. Check 2. Free cash flow. Ensure dividends are covered. Check 3. Dividend history. Steady increases versus erratic cuts. Prioritize business health and dividend growth to build a reliable, growing, passive income stream. One of the most powerful forces in the universe, as Albert Einstein reportedly called it, is compound interest. In the world of dividend investing, this force is harnessed through something called a dividend reinvestment plan, or DRIP. Nearly all brokerage platforms offer this simple but incredibly effective feature. When you enable DRIP for a particular stock, instead of receiving your dividend payments as cash in your account, the brokerage automatically uses that money to purchase more shares or fractional shares of the very same company. This creates a virtuous cycle that can dramatically accelerate the growth of your investment over time without you having to lift a finger. It's like a financial snowball rolling down a hill. It starts small, but with each rotation it picks up more snow, growing larger and faster as it descends. This compounding effect leads to an important and highly motivating metric that every dividend investor should track: yield on cost. While the current dividend yield tells you the income return based on today's stock price, yield on cost tells you the income return based on your original purchase price. As a company continues to increase its dividend year after year, your yield on cost will grow. For example, if you bought a stock for $100 per share and it paid a $3 annual dividend, your initial yield was 3%. If, 10 years later, the company has grown and increased its dividend to $6 per share, your yield on cost is now 6%. $6 dividend divided by 100 original cost. While new investors are only getting a 3% yield at today's higher price, you are earning a fantastic 6% return on your initial investment. This is why dividend growth is so much more powerful than a high starting yield. A stagnant 8% yield will always have an 8% yield on cost, but a 3% yield that grows steadily can eventually provide a 10%, 15%, or even 20% annual return on your original capital, all while the value of the underlying shares has likely appreciated significantly as well. For many, the dream of earning passive income from real estate conjures images of owning apartment buildings, collecting rent checks, and steadily building equity. However, the reality of being a direct landlord often involves far less glamour and far more work. It means dealing with unexpected maintenance calls at all hours, chasing down late payments, and navigating the complexities of property management and local regulations. It also requires a substantial amount of upfront capital, putting direct property ownership out of reach for most people. But what if you could capture the financial benefits of being a real estate mogul, the steady cash flow, the appreciation, the inflation protection, without ever having to fix a leaky toilet at 2 a.m.? This is precisely the opportunity offered by real estate investment trusts, or REITs. A REIT is a company that owns, operates, or finances income-generating real estate across a wide range of property sectors. This structure makes investing in large-scale real estate as simple as buying a share of any other stock through a standard brokerage account. This accessibility is a game changer. The core difference between investing in a REIT and owning a rental property yourself is the shift from active involvement to passive ownership. You become a landlord to thousands of tenants across hundreds of properties, all from the comfort of your home, with just a few clicks. The primary reason REITs are such a beloved asset class for income-focused investors lies in a special legal requirement they must follow. To qualify as a REIT and avoid paying corporate income tax, a company must, by law, distribute at least 90% of its taxable income to its shareholders in the form of dividends. This single rule is the secret sauce that transforms these real estate companies into powerful income-generating machines. This avoidance of double taxation allows REITs to typically offer dividend yields that are significantly higher than many other dividend-paying stocks in the S&P 500. Many REITs, especially in stable sectors, choose monthly dividends rather than the more common quarterly schedule. Receiving 12 dividend payments per year instead of 4 creates a cash flow stream that resembles a traditional paycheck. It makes budgeting easier and provides a more consistent flow of passive income, bringing the dream of living off your investments one step closer to reality. One of the most exciting and rapidly growing sectors is data center REITs. These companies own and operate the massive, secure facilities that house the servers and networking equipment, forming the backbone of the digital world. Every time you stream a movie, use a cloud application, or interact with an AI chatbot, you are relying on the infrastructure provided by a data center. Another powerful, demographically driven sector is healthcare REITs. The primary tailwind for this sector is the aging of the global population, particularly the massive baby boomer generation. Industrial REITs, for example, own the warehouses, distribution centers, and logistics facilities that are critical to the e-commerce supply chain. Every time you click Buy Now on an online order, that product likely passes through a building owned by an industrial REIT. By combining these different sectors, you can build a truly diversified and robust real estate income stream. My own journey into REITs started small, with a single investment that generated a dividend of just $5. It was not a life-changing amount of money by any means, but I remember using it to buy a coffee. That coffee tasted different. It tasted like freedom. It was a tangible reward that I had not actively worked for. It was earned by a shopping mall in a state I had never even visited. That small experience solidified the power of this concept for me. By starting with a diversified REIT ETF or a few high-quality blue-chip REITs, and by understanding both the incredible rewards and the inherent risks, you can begin to build a portfolio of digital properties that work to pay you, month after month, year after year. While the growth potential of stocks and REITs is exciting, a truly resilient portfolio needs a foundation of stability and predictability. This is the role of fixed income investments, primarily bonds. At its most basic, a bond is simply a loan. When you buy a bond, you are lending money to an entity, a national government, a large corporation. In return for your loan, the issuer promises to pay you periodic interest payments, known as coupons, over a set period of time. At the end of that period, called the bond's maturity, the issuer repays your original principal in full. This creditor relationship places you higher up in the capital structure than stockholders. In the unfortunate event of a bankruptcy, bondholders must be paid back before stockholders receive anything. This seniority is what gives bonds their reputation as a safer asset class. For much of the past decade, bonds fell out of favor. Interest rates were at historic lows. However, the financial landscape has undergone a dramatic shift. Central banks around the world have raised interest rates to combat inflation, ushering in a higher for longer rate environment. It has been a monumental gift for income-focused investors, making bonds more attractive than they have been in over 15 years. Suddenly, investors can find high-quality government bonds and high-quality corporate bonds offering yields of 4%, 5%, or even more. They act as a crucial diversifier and a shock absorber for your overall portfolio. This flight to safety can cause bond prices to rise while stock prices are falling, creating a stabilizing effect that helps cushion your portfolio against steep losses and allows you to sleep well at night, a benefit often referred to as the SWAN, sleep well at night factor. The true magic happens when you begin to combine them. The ultimate goal is to move beyond just earning passive income and start creating a system where you are earning money almost daily. It is all about intentionally diversifying the payment schedules of your different investments. By layering assets with different payout frequencies, you can fill your calendar with income events. This is the snowball effect in its most visible form. This method has a profound psychological benefit. Seeing money regularly hit your account, even in small amounts, provides constant positive reinforcement. It keeps you motivated and clearly demonstrates that your strategy is working, transforming the abstract concept of passive income into a tangible daily reality. Building this income machine is exciting, but success depends on disciplined execution. Automate contributions and reinvestments, prioritize asset quality, and track real income growth. Passive income isn't a get-rich-quick scheme. It's a get-free-slowly strategy. The single most common regret among seasoned investors is not that they picked the wrong stock a decade ago, but that they did not start investing sooner. The best time to plant a tree was 20 years ago. The second best time is right now, today. If you found this deep dive into passive income valuable, please consider hitting the like button. It is a small gesture that tremendously helps the algorithm connect us with more future investors just like you. And remember, the road to financial independence is far easier when you do not have to walk it alone. This is where our partner, InvesYou, can become your most valuable ally. Their platform is specifically designed to give you the data, the community, and the confidence you need to stop trading your time for money. It simplifies the process of tracking your income, monitoring your yield on cost, and discovering new opportunities that align with your goals. We strongly encourage you to head over to the link in our description, sign up for their newsletter, and explore the tools they offer. Let's work together to start making your money earn for you, not just once in a while, but daily. Keep learning, keep investing, and never forget the incredible future you are building for yourself with every single dollar you put to work. I look forward to seeing you again in the next video.